Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat as usual here on Wednesday afternoons by my good friend Connie Hill, 20 plus year veteran of the financial markets. She's there as always to help answer your questions along the way. For those of you here with us live, be a part of that conversation. If you're here in the recorded version, leave us a comment in the comment section. We'll get back to you as quickly as we can on those. Interesting day in the markets. The indexes seem to be, at least at this point, the SPX, NASDAQ, both up, and in the case of the S&P 500, up pretty significantly. So we'll take a look at that today. We'll take a look at some of the reasons driving that and how that's impacting volatility, how that's impacting some of the example trades that we have, and we'll take a look at perhaps some new opportunities here. So as we jump into this, a couple of quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes. Only remember that anything that we discuss, any individual symbols that we look at, those are simply illustrative examples. Remember when we talk about trading options, specifically equity and index options, carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Also, one other thing to think about in this conversation, one of the reasons why we talk about trading index options as an alternative to trading equity options, with a long equity option that may result in a long or short position in an underlying stock that then carries, if that option were carried into expiration and turned into that long or short position, that carries position risk. And so there is the potential to lose more than was initially invested in that long option position. With an index option that is cash settled, meaning it results in not a long or short equity position, but results in cash in your portfolio, well, you don't have that positional risk. So that's one thing to consider as you compare those two ideas. Now, we're going to talk about primarily European style index options, which means that they cannot be exercised prior to expiration, which means that if you're short a European style option, it can't be assigned early. But American style options can, and oftentimes, many times, may be assigned early. So just be aware of that fact. Now, when we're talking about what we're doing today specifically, we're using the thinkorswim desktop software platform, specifically the paperMoney version of that platform. paperMoney does not facilitate the early assignment of short options. So if you were short an equity option that is American style, there's the possibility that you could be assigned early, but you're not going to see that in paperMoney. A couple of other things to pay attention to. We're obviously going to use some technical analysis in this discussion, probability analysis as well. Those are both theoretical in nature. None of those are guarantees as to what the market is going to do. So let's jump out here into the market and see what is going on as we take a look at what's going on here with the S&P 500. And we talked a bit about this last week. Talked about the strength that's happening in the S&P 500, looking at that 7,400 mark as potentially a little bit of a resistance area. And in fact, today, with economic data and earnings, we see a little bit of a blow past that 7,400. In fact, we're sitting at 7,451 right now with about an hour to go to the market close, the cash market close. So some strength to this move. 50-period moving average moving up and away from the 200 period, which is moving up as well. Taking a look at the NASDAQ, also a strong move, although not quite as strong a breakout move when you look at it from a resistance level. So I take that because the NASDAQ is an index that is primarily focused on technology. The fact that the NASDAQ is not leading this breakout suggests, but it's not, obviously this is a circumstantial correlation, is that because the S&P 500 is seeing a breakout and not really the NASDAQ. And the NASDAQ is a strong candle day today. And in fact, that's a bull flag. You could even look at that as kind of a morning star type of candle pattern with that doji cross Um, Sometimes some people would call yesterday's candle a butterfly or a dragonfly doji, with that idea that we see this upward movement. But the fact that the S&P 500 is leading suggests that maybe there's a little bit more breadth to this market than just what we're seeing in technology. And so that perhaps is indicating where maybe some of that strength lies. Now we look at the Russell 2000, which tends to be a little bit more diversified. It is the small cap index, diversification from an allocation standpoint, not necessarily from a a size standpoint, because you do have some mid caps and others in those other indexes as well. But with this being primarily focused on small caps, not seeing a lot of strength here today in the small caps, but seeing a little bit of a pullback and a little bit of a bounce here in the Russell 2000 in that small cap index. Let's take a look really quick while we're here at what's going on with volatility. And so we're going to jump over to the VIX grid, and we're going to take a look at what's happening with volatility, the overall pricing structure, if you will, of index options on the S&P 500, the SPX index, as a measurement of a couple of different things. I mean, it really boils down to, are these options getting bought or are they getting sold? And when we see that implied volatility, i.e. the VIX, is rising, that's an indication that those options are getting bought and that institutional traders are not really concerned about what they are paying for them. And especially when we see these big spikes. But we're well off of a big spike in the VIX. Yesterday, we saw kind of an interesting perspective. We saw a little bit of a market down, VIX down scenario, which doesn't happen very often. Today, we're seeing a market up, VIX down, but not down significantly. And I'll tell you we've talked through some of the reasons why that we're seeing the VIX staying relatively elevated, because here we are today in the mid to upper 17 handle. Last week when we talked about this, we were at about the mid 18 handle. Now we're at about the mid 17 handle, or high 17 handle, so it's bled off just a little bit. What that would suggest, perhaps, is there is a bit of call buying as well for the purpose of speculating. And I don't think today's upward move is going to abate that call buying by any means, although there might be some profit taking. Who knows? We've broken through a major level. 7,400 is a big round number that can oftentimes be a psychological level of resistance. So there might be a pullback and a retest to that level and a breakout, or a breakdown from that point. And again, we've got geopolitical news in the world. We've got through some economic data, but we're going to get into some more economic data the rest of this week. We're coming to the end of earnings season. We're going to have consumer confidence numbers and retail numbers coming up still. So there's still a lot of market news to be had in recent days and coming days. So the fact that the volatility is staying a little bit elevated could be more volatility based on speculation. It could also be volatility based on the fact that institutions are kind of putting in a floor as far as where they're willing to start to buy some hedging activity or starting to buy some options to offset potential risk to the downside. Now, we're going to kind of take a hybrid approach to this from the standpoint of what we've been doing in this webcast for almost 2 years now, better part of a year and a half. And that is, I'm going to pop over to our monitor tab and we're going to take a look at this. We're going to jump over here into our index options weekly strategy. And let's work through this one to begin with, and then we'll kind of come back and look at a couple of other new ideas here in this discussion. So this is the strategy that we've been talking about on an ongoing basis, and it is simply using short vertical spreads so that we put time decay to work in our favor. So using short vertical spreads in a directional fashion when the market is moving in a particular direction, when the S&P 500 is moving in a particular direction. So I've got on here right now the last one that we did last week. We sell the vertical spread at 14 days to go until expiration. We buy it back at 7 come what may. So here we are at 7 days. Nothing magical about Wednesdays other than the fact that it's the day of the week that we teach this particular webcast. We sold this vertical spread, $20 wide vertical spread. We sold it for $1.70. It is now trading for 37 cents. It's done the majority of the work that it can do for us. In fact, in this case, it's done about 55% of the work that it could do for us, if we want to think about it from that perspective. Maybe 60% of the work that it can do for us. And we are at 7 days to go until expiration. So we're simply going to close this one down. And in fact, today has accomplished a fair amount in terms of putting this to work in our favor. So we sold it for $1.70. We can buy it back for 30 cents. And that puts us in that position of realizing or keeping about as much of that premium as we can expect to keep. Now, could this go lower? Yes, but it doesn't really benefit us to hold on to this to pick up an additional 30 cents for the sake of holding on to all of that risk that we had in the trade. $20 minus the $1.70, fair amount of risk in the trade, but a highly probable trade. So I'm going to right click and we're going to create a closing order and we're going to simply buy this back. Now we could create a roll, but I want to talk through this so that we keep our methods consistent. So I'm going to just simply left click here, buy back this vertical spread, and we're going to put in that order. We're going to try to work that down just a little bit here. We'll see if we can get it for 30 to 35 cents. I'm going to see if we can get it for 30 cents. We're going to click on confirm and send. Read through that order to make sure that we are closing this trade down. We're going to click on send and we'll see if we fill. That filled for 30 cents. And it makes sense because from that standpoint, this is paper money, so it's going to fill at the midpoint generally. If we were trading a live trading account, it may require some patience to work our way out of that, but this is a very liquid product. So take that for what it's worth. Okay. So now Rita says, would the profit be more if we were to buy 30 days out and then, or sell 30 days out and then buy back at 2 weeks in? Try it and see. You know, the idea behind this is that we kind of keep this on a weekly basis, but if you're not that active, for instance, if you don't want to have that level of activity or your summer plans don't allow for that level of activity, this is a strategy that lends itself very well to the idea, because all this is proof of concept in terms of proving the consistency of this type of strategy. So could you do 30 days and buy 2 weeks in? Yes. The difference is going to be rate of time decay. And this is at its core primarily a time decay trade. Directional, yes, but marginally directional, but it is primarily a time decay trade. And it's primarily designed to capture time decay at the outset, or the initial outset of the trade. So let's put the new iteration of this trade on. So I'm going to go back to my charts and I'm going to change this to my index options grid. By the way, I will share this index options grid and its associated tools out here in the chat. For those of you that are in the chat, it's going to be right there. And remember that anytime we share anything, it is not guaranteed as to time or accuracy. This is also posted in the description page for this particular webcast and for all of these index options webcasts that we've been teaching. So the filter in this case is very simple. The directional filter is the SPX above or below the 200 period moving average? And right now it's well above that 200 period moving average. So if it's above the 200 period moving average, if the SPX is above the 200 period moving average, we sell put spreads. We're directionally bullish. If the SPX were below the 200 period moving average, as it was back in this time frame, right, mid-March into April, then we sell call spreads, and we are directionally bearish. So well above the 200, we're directionally bullish. We have a big up day today. Now, by the way, speaking of big up day, we have a big feedback survey right there in the chat for you. Connie's going to repost that. But do me a favor. Help us out to make these sessions better. The only way that we can make these sessions better or respond to the things that you would like to see in these webcasts, and by the way, we read all of the comments, is if you fill out that feedback survey for us. So do that for me. Fill out that feedback survey. Let us know, and you've got an open comment field there to comment on things that you would like to see. All right. So what we're going to do, we know that 14 days to go until expiration is going to be the 27th of May. So I'm going to go to my charts, and I'm going to move this line. Now, this shorter term chart on the right-hand side, that is a 3-month, 1-day chart, 3-month daily chart. Left-hand side is a 1-year daily chart. Okay. And so what we're going to do is we're going to right-click, and we're going to just activate this line, and we're going to drag it out to the 27th. So there's 527 right there. We're going to drop that line. So Rodney asks the question, is there any advantage to adding a good till cancel order to capture 50%? So closing the trade down when it gets to 50%. Sure, that kind of automates the process. And you can certainly do that. And many people do accomplish that process by putting in that type of order. So one of the things that you might think about is, yeah, that would kind of put it on automated, right? 50 period moving average, that is that orange line, 200 period moving average is the blue line. So you can do that. I don't do that in this class because I like talking through the process, but Rodney, absolutely. MBH asks the question, do I use the Greeks to choose which put spread to sell? In a way, yes. And we're going to talk through the Greeks here in a minute. But what I'm going to do now, and I'll take us over to this right-hand side, and I'll maximize this cell, is I've got the probability of expiring cone. The probability of expiring cone tool or study, which is right here, is simply an expression of one standard deviation statistical move above or below where the price of the stock is currently at a particular date based on implied volatility. So I'm just going to look for that crossover point. In this case, that crossover point is going to be, I'm going to call it the 7,200 strike right there, 7,200 strike. And I'm just going to go to that crossover, and I'm going to put a hash mark right there. 7,200 is our short strike. I'm sorry, yeah, is that 7,200? Yeah, 7,200 is going to be our short strike. So now what we're going to do is we're going to go to the trade tab. And you can see where that puts us. I mean, you can see that his implied volatility has gone down. The distance between where the price of the stock is and where our short strike is has shrunk. When implied volatility goes down, this probability of expiring cone shrinks. When implied volatility goes up, that probability of expiring cone gets a lot wider. We're at low implied volatility. The VIX is low. The implied volatility of the SPX itself is low. That probability of expiring cone is fairly narrow. All right, so now what we're going to do is we're going to come back over here to the trade tab. We're going to go to the 27th of May, and we are going to open up the number of strikes that we need. In this case, we're probably going to need about 120 strikes, I'm guessing. And that'll give us that 7,200. Probably needed less than that. But here's that 7,200 strike. And you notice, we'll just kind of double check the Greeks here, MBH, but that's about a 14-cent delta, which expressed in probabilities is about a 14% probability that the strike price is going to be at or in the money at expiration, which means this is a high probability trade. The goal here is for this to stay out of the money. High probability trade. So what we're going to do is we're going to do this. We're going to go to 7,200 and we're going to sell that one. And we're going to buy 20 strikes in, or 20 points in. So we're going to buy the 71.80. Now, why 20 points, you ask? Well, that's just simply to establish consistency. And we've talked through before the idea of the wider we make that strike, or that spread, the more absolute potential theoretical loss we add to the mix. But we save a little bit in terms of premium. But you add more risk. So there's always the trade-off. You create those narrower spread, it's going to be costing more to define the risk, meaning buying the long side, but you reduce the amount of risk. So you're going to see less premium but lower risk. So that's always the trade-off. 20 is not a magic number. 20 points is not a magic number. It just seems to be consistent with what we've been doing in the SPX here on an ongoing basis. So last week we got $1.70. This week we're getting about $1.90 in this particular case, and that may be indicative of maybe a little bit of buying pressure still kind of hanging out here at this level. But I want to do this really quickly as we're talking about this. Okay. Hold the control key down, Rita, when you're doing that. Hold the control key down. So when I created this, I went to the 7,200, left click on the bid, hold the control key down, and then come back to the 7,180. Hold the control key down while you click on the ask, and that'll create that spread for you. So think about this. We're left with a trade. So if this one has 14 cents of delta sensitivity, and this one has minus 12 cents of delta sensitivity, we're left with, you got it, 2 cents of directional sensitivity. So it's not a very directionally sensitive trade. Still has a bullish bias, but not very much bullishly biased. Now let's talk about time decay and Vega. So we're talking about $1.85 minus about $1.75. So we're left with about 10 cents of time decay working in our favor every single day. And if this and more rapidly working on this trade at the outset rather than towards expiration, because it's an out of the money option. We're far out of the money. We're at the 14 delta. So time decay is going to work more rapidly to begin with, and then it's going to slow down. We've talked through that a few times. Now, what we're left with here then is volatility. And so volatility, this is a volatility sensitive trade. Now, the idea is volatility is pretty low at this point. So this is something that could hit us in this particular trade because we're left with $3.21 minus $2.99, $3. So we're left with about 22 cents of volatility sensitivity. That by far is the greatest sensitivity of this trade. And so if implied volatility rises significantly and it does it quickly, that can work against this time decay pretty quickly. So that's something maybe to be concerned with. And that might be something that but remember, an option sensitivity to implied volatility decreases as we get closer to expiration. So at the outset, this has 22 cents of implied volatility sensitivity or Vega sensitivity. But at the time we get to next week, that's probably been cut in half as we get closer to expiration. So something to pay attention to. So let's go ahead and let's fire this order off. And while I've been talking, that's dropped down. We'll kind of work this a little bit. See if we can get $1.90 for it. We're going to put this in our index options weekly group. And we're going to fire that order off and we'll see if it gets filled. We got $1.90 for it, which is great. I'm glad to get $1.90 for it. And in this particular case, there it is now. Here's our new vertical spread, $1.90. We want that to get as cheap as possible, as quickly as possible, and work in our favor. And we're going to do this again and again and again every week. Now, how do we put two charts together with that probability of expiring curve? It is simply a grid. I've got two charts in my grid. Left-hand side is my longer term chart. Right-hand side is my shorter term chart. I will go ahead and share that as well out there into the chat. Again, not guaranteed, but I want to make sure that you've got it. It's also in the description page so that you can get it right there. There you go. All right, so cool. All right, so let's take a look at what else is going on here in terms of some of the trade examples that we've got. So I'm going to pop back over here to the monitor tab. We're going to close that one down. We've dealt with that one. Wanted to look at a couple of other examples here. We've got this trade going on right here, which is MGTN. And a couple of people have asked me about this on social media and elsewhere. And we've rolled this a couple of times, but I wanted to look at this when we talked about leaving this till today in terms of managing this. We were directional about this index is the Mag 10 index. So let's put this in the chart. I'm going to put this on my single grid real quick. Let's go to our single grid and we'll go MGTN CGI. That's the symbol, MGTN : CGI. this particular index tracks the Magnificent 10 stocks. And those Mag 10 have been the leaders for the most part. You can see that this echoes what the S&P 500 has been doing. It echoes what the NASDAQ has been doing. And now we have it kind of bouncing into a little bit of a resistance level here, perhaps right around this 506 mark. Banging its head into that resistance with a couple of advanced block candles isn't really conducive to a bullish trade. So go back to our monitor tab. We've got this short put spread on here. And expecting, let's see, if we do this, let's go to create a closing order, buy it back. So we're short this vertical spread, and it's basically done all that it can do for us. It's pretty much at a zero bid at this point, and it's kind of bouncing back and forth. So we're going to look at closing this trade down and maybe hedging off a little bit of this upward movement. We'll see if we can do that. So I'm going to right click and I'm going to create a closing order, and it's at zero bid. And this is a problem. We might have a problem getting out of this trade. So we might have to work this back up towards the natural a little bit and be willing to pay a little bit to buy this back. And we're going to buy this one back and close this trade down. We'll see if we can get out of it. Again, one of the challenges in terms of liquidity is being able to exit positions. So if you don't have a lot of liquidity, that maybe becomes a bit of a challenge. But this is an index option. This is, again, a European style index that tracks those Mag 10 stocks. So you could use this to gain exposure. So we might have to work that order a little bit, see if we can maybe get out of that trade. I'm going to bump that a little bit just because I do want to exit that position. Now, I could let it go to worthless, but I'm carrying that risk. So I want to be able to exit this position positively. So I'm going to maybe bump this a little bit more. I'm going to give it maybe 10 cents. Click on confirm and send. We'll send that order off again. And we'll see if we can get that to fill here within that range. But you notice that that bid-ask spread was bouncing back and forth. We've got, in this two-legged option trade, this vertical spread, we've got two bid-ask spreads we've got to cross. So that may be a concern in terms of liquidity. And again, it speaks to the idea of how you select strategies to trade. So the other thing that I wanted to look at here in terms of our index options is, let's pop back over here to our Russell 2000 index. I think we already had one on there, right? Let's go back and take a look at our Russell 2000 index. We do. So we've got this vertical spread on the Russell 2000. And it's, if we take a look at this trade, right click, create closing order, this was a long put vertical. We were expecting the index to move to the downside. We got 36 days to go until expiry on this particular trade. This is the small caps, Rita. This is RUT is the small caps. So this trade, and here's one of the reasons why we manage trades, spread trades, but we maybe don't manage them using a stop order, because this is at a point where it's lost about half of its value. I bought it originally for $6. I was looking for this to move to the width of that spread, which was $15. It's lost about half of what I paid for the spread to begin with. And it's done it fairly quickly, but I've got 36 days to go until expiration. If we look at the chart for the Russell 2000, RUT, it's kind of banging its head against that resistance and pulling back a little bit, but it's also at the same time giving us that possibility of a little bit of a bounce. So we're long this vertical spread to the downside. My thought is this: what if we were to, instead of exiting that long put vertical, which still could see some benefit from a downside move, What if, and we've got 36 days to go, what if we were to combine that with the idea of selling a shorter term, cash secured put's not going to work because that's going to be pretty capital intensive. But what if we were to sell a shorter term put vertical spread, short put vertical spread? And then essentially what we're creating is a butterfly spread, for instance. And we're looking for movement. What we're doing is we're financing the long side of this combination by selling the short side of the combination. So we know that implied volatility, if we look at implied volatility here, come down to this and we look at where implied volatility is on this option, implied volatility is not terribly high, nor is it terribly low. So we might look at where we could sell a short vertical spread, short put vertical, which has a bullish bias, but gives us that opportunity to bring in some premium and maybe buy down some of this loss or use that to finance some of this loss that we've taken on this long put vertical spread, which has a bearish bias. We expect the price of the stock to move, or the price of the index to move down. So let's go to our trade tab here. And let's see if we can come back here. Let's try 14 days to go until expiration. And we're going to, again, just for that symmetry standpoint, we're going to do something similar to what we're doing with the SPX option. So what I'm going to do is I'm going to find roughly that same level, kind of right around that 14-15 delta. And let's see where that puts us. That puts us kind of nicely at the 2720 level. Let's look at where 2720 is. 2720, I like that. 2720 is kind of right at or just below that level of support. So I'm going to sell a short vertical spread at or below this level. So I've got let me just kind of line this out so that we see what we're doing. I've got the long vertical spread here, the long put vertical spread up here, which has a bearish expectation. I'm now looking at selling a short put vertical. So I've got a long put vertical up here, LPV. And now I'm going to sell a short put vertical that has a bullish bias, but that's going to bring us in some capital. This one cost us capital to buy. But we're looking at that, giving it that a little bit more time to move to the downside, because maybe we go sideways for a little bit. Maybe it stays kind of right around this range. We'll see what happens. So this is one way that we can use what we know about vertical spreads, what we know about technical analysis and directionality to maybe help us to offset what that cost of that long vertical spread was. So go back to the trade tab. We'll go right around to that 2720, 15 delta strike. And so I'm going to sell that 2720. And I'm going to look at buying. I'm going to go 10 wide on this one, just because it's a little bit narrow, or a little bit, actually, you know what? Maybe we still go 20 wide. Let's go 20 wide. That gives us a little more directionality, a little more premium. The loss is a little bit bigger, but we're bringing in $2.25 against about $1,700 of risk. But that $2.20 is going to get us all the way back almost to what we paid for that trade to begin with. And that's going to kind of finance some of that loss potentially that we took in the long side of this. Essentially what we're doing is legging into a butterfly spread, right? We're legging into a kind of a wider butterfly spread here, if you will. So I'm going to come back here. I'm going to put this in my index options group. And I'm going to look at selling this one. This is the 2720, 2700 short put spread. Bullish bias, bringing in premium. It's going to benefit from rapid time decay because it's out of the money to about the 14% or 14-cent delta, which is about a 14% probability of being in the money at expiration. And that premium that we're bringing in will serve to offset some of that loss that we've taken in the long vertical spread, which has a bearish bias expectation. But then if at 7 days, next week, we look at this and this has become significantly cheaper, we can look at buying it back just so we do with the SPX option. And so we'll fire that order off and we'll see if that'll fill for us. It might not in this particular case. We might have to bump that because I was talking a little bit. Whoops, cancel. Let's go right here, right click, cancel, replace the order. And it's out at about the 225, which is okay. I'm going to bring that down a little bit. I'm going to say, all right, I want to get at least 210. I might have to go closer to the natural here just to get that filled, but let's see if we can get that to fill here in that index options group. We'll put it in the index options group, click on send, fire that order off, and we got 215 for it. So we just had to bump it down a little bit. And again, sometimes you have to do that in paper money. You're almost likely to have to work your order a little bit in a real money account just to see where that market is moving to. Now, this is going to fill algorithmically. It generally will fill at those midpoints, but sometimes the algorithm gives us a little bit better. So now what we've got, if we go back to our monitor tab, we take a look at what we've got in the mix here. Now we've got two vertical spreads. We've got a long put vertical spread. That's the one that expires in June. It's got some time to it. And we've got a short put vertical spread that we brought in a little bit of premium. And that is kind of offsetting some of this loss between the $6.05 that we paid for our long vertical spread and the $3.35 that it's trading for right now. All we did is we created. Now, if we come over here to the Analyze tab and we take a look at what this looks like, I'm going to go to Risk Profile and I'm going to hide simulations, and I'm going to go to RUT. We're going to see what this looks like in terms of these spreads that we've got. So we've got some positional risk here, right? The positional risk is that we get a move to the downside beyond our gain in the trade. We've got kind of a discrete point here at the 27.26 mark. And if it goes way up, we've got a risk as well. But we've got a range here between about 27.18 and about 28.11 in which we stand to make some money. Now, obviously, these are two different durations in this trade. So we've got a combination of both spread, normally a butterfly is going to be one expiration. So we've spread that butterfly out across two expirations. That's why it's got kind of this weird look to it, this kind of divot in that potential maximum loss. But the intent here is that the short vertical spread, the one that we just put on, gets cheap really fast. And then maybe we sell another one into that expiration month, into the June expiration cycle, so that then this becomes lower cost butterfly spread in looking at kind of capturing that sideways movement in the Russell 2000. So a number of different ways that we can approach trades like this. And so that is one of those characteristics and one of those types of trades that we can look at where you take your knowledge of long vertical spreads and short vertical spreads, take your knowledge of trades and building strategies and kind of combine them together. Now, here's the thing. The long vertical spread, if this does go down, that now goes in the money. And that puts us at or near max theoretical gain, right? Because as we get to expiration, we could get to near max theoretical gain, but we got to wait for that intrinsic or that extrinsic value to decay away. If we've got a short vertical spread, like we do here in this case too, going down puts that vertical spread at risk. Going up a little bit helps that vertical spread. Staying where it is helps that vertical spread. But remember what we've taken out of this mix. And the reason I feel comfortable in this case, more comfortable, selling the short vertical is because I don't have to worry about early assignment. I don't have to worry about getting hit on that short put that we created at the 22 or at the 15 delta down there at around that 27 that 2702 or 2700 level where we sold that vertical spread. I don't have to worry about that getting assigned early. like I would on an equity. So that's where the benefit of this, using this on a vertical or on a European style index option, may make a little bit more sense in terms of building kind of a combination trade like this. And so that's one way that you can approach it. All right, so let's do this. I want to pop back over here really quickly to this page right here. And I wanted to take you to a couple of things because, again, both of these trades that we put on, the trade examples that we put on today, have been focused on vertical spreads. So for those of you who are here right now, or in this, watching this in the recorded version, who maybe don't have that experiential knowledge of vertical spreads, I wanted to give you some resources. So here's a couple of resources. Here's Connie. And by the way, Connie teaches this particular webcast. This is her playlist, long verticals and diagonals. Brett Crowther teaches short verticals, which is the other side of that equation. But these are some great webcasts that you can use to build your skills in those multiple leg option strategies, specifically verticals, and how you might combine those together. And I know this is something that Connie talks a lot about in her webcast, in those long verticals and diagonals spread. So this is a great resource that you can use to build your skills now that maybe you've had an example or an illustration of how those can be combined together. So do me a favor, when you come out here, click on subscribe. If you've not done so already, it benefits you, it benefits us, it benefits other traders who are trying to find this content. Remember to click on that, fill out that feedback survey. And by the way, I'm going to just show you this really quickly. I'm at schwab.com/coaching. I'm going to in-person events. So coming up this weekend is our Market Drive event in Chicago. So if you're in that area, come and visit us. I'm not going to be there, but Kevin Horner is going to be there. Kevin Hinks, Alex Coffey, Kevin Green's going to be there. Jim Urio, Joe Mazzola. That's at the Renaissance Schaumburg on Saturday coming up. Then I'm going to be in Santa Clara on the 29th and 30th with Kevin Hinks teaching the Advanced Option Strategies live workshop. Now, by the way, this one is full. So your next opportunity to see that Advanced Options workshop is coming up in New York. And that's going to be a fun class. But after Santa Clara, we're going to be in San Diego teaching the Technical Analysis and Option Strategies live workshop. So come join us. Love to have you be there with us. These are all at no cost to you. Just click on that Learn More for the registration information. We'd love to see you there for that. Remember to click on the feedback survey. My thanks to Connie Hill for helping out. My thanks to all of you for being here, whether you're in the live version or the recorded version. Thanks again. And thanks to our great producers and our reviewing staff for doing a great job. We'll see you guys again very soon. Take care, everybody. Bye-bye.